If you traded SPY using seasonality patterns, you probably lost a lot of money in 2025. 20-year-old seasonality patterns broke this year, and I think the fact that they broke this year is what sets up 3 very specific trade ideas for 2026. And that's what I'm going to share in this video. We're going to start by first understanding what went wrong in 2025, and I use the words wrong in quotation marks, but really what deterred from historical patterns, and where do we have opportunity. Now there's 3 key ideas I want you to pay attention to. The first is these traditional patterns, which I'm sure you've heard of, which include the spring rally and the Santa rally. Both of these rallies never came. As I make this video, it's December 30th, so assuming tomorrow isn't some incredible rally, both of these traditional patterns, which we're used to seeing, the spring rally and the Santa rally, did not occur, did not trigger in 2025. So we went away from historical patterns here. 2, summer outperformed this year. The old adage, sell in May, walk away, did not really work out for you this year. If you sold in May, you left a lot of money on the table. And 3, the one pattern which was consistent, still reliable, was the weakness, the persistent weakness inside of the month of September. All 3 of these ideas are a little easier to see when you actually visualize them. So let's take a look at 2 charts. The first chart is going to be around frequency. And so here we're going to look at seasonality patterns and how frequently they trigger. You'll see there's 3 lines on the chart. The blue line is what happened this year. The orange line is what tends to happen over the past 5 years. So this is 2020 to 2025 worth of data. And then the gray line is 20 years worth of data. So going back to 2005. And before we move forward, let me actually tell you what these numbers represent. So whenever you see 100 here for the blue line, that means that particular month, so in this case January and February, were up months, since that's looking at just 2025. When we're looking at that in the sense of the 5-year average, for example, 60% of the time, January closed above where it opened at the beginning of the month, meaning it was an up month. So the higher the number here, that means the higher the frequency that the month closes above where it opened, meaning it was a green month. So inside of January and February, S&P continued to see the strength that we're used to seeing, 60-80%, but we outperformed. So here you might expect to see a little bit of weakness as we head into January, February of this year, given that we saw a lot of strength last year and we're expecting price to revert back to the mean. That takes us to March, April. You'll notice this is that spring rally. Typically, we see price has accelerated during this period. Instead, this time, price did not accelerate. We had 0% of the time, meaning both March and April were down months. Then we move on to the summer months here. In summer months, you'll notice we closed up and we saw persistent strength, at least from a sense of how often we closed above where we opened at the beginning of the month. And the next chart will show us what was that average move, what was the actual percentage that we moved. So we see summer strength here, whereas typically we see summer weakness. And so we did not see that sell in May, walk away pattern hold true. Instead, it was better to hold through May all the way up to September. That's where we saw that same weakness, September weakness, come right back in. We're used to seeing it over the past 20 years, and we saw that happen last year as well. Then comes in the Santa rally. Typically, we're used to seeing some sort of a Santa rally, either in the November, December period, and this time that did not happen. Even that Starbucks holiday drink pattern worked, but it was a little bit more sparingly in the sense of how it worked. Now, the next chart we're going to look at is around the actual percentage move. Now, this will give us context around what was the actual amount that S&P either went up or went down and does so on average. So same idea, we have 2025, then we have the 5-year, and then we have the 20-year period. Now, if we start by taking a look at the numbers, you'll see January outperformed, but February was very much in line with what we're used to seeing over the past 5 and 20 years. So that's why if you were to say 1 out of the 2 months should revert back to the mean, I would put my hedges on January being the month in which we revert back to the mean. Then comes in March. You'll see just how negative of a month March was. March was a weak month, whereas typically we see a little bit more of that spring rally. So you'll see this large gap here between what tends to happen versus what actually happened. Similarly, you'll see that gap in the May period after May, the whole sell in May. Notice just how large this gap is here. That gives you an idea that S&P continued to have strength in May, in June, and in July is where we came back within our 5 and 20-year average periods. August still continued to outperform. You see the gap here against what typically tends to happen. And it's only in September where we came right back down to that negative period, very much in line with what we're used to seeing somewhere in the 0 to negative 3% range for the S&P 500. October, you can take a look to see that we're right back within our averages. November, December, we're below what we're used to seeing. December is in line, but November a little bit below. So now if you were to pick periods in which you expect price to revert back to the mean, I would be looking for these largest gaps here. So March stands out to me. This period from May onward stands out to me. And then we have the November, December period, which stands out along with August, which had a little bit of an outlier in terms of the summer month. We need to now put all of this data together. And by the way, before I continue too deep onwards, I used our free seasonal analysis indicator to gather the data for this indicator. This is how it looks. So again, the two numbers that we plotted the charts with, the first number is the frequency. The second number is the average percentage gain or decline based on what actually ends up happening. This is our free seasonal analysis indicator. I'll leave a link to download it in the description box. I ran this exercise for SPY, but you may want to repeat it for the Qs or even a particular symbol. As long as Thinkorswim supports and has X amount of data for it, you'll be able to use the indicator. Now, all of that takes us to 3 trade ideas for 2026. And by now, you should have hopefully gathered these 3 trade ideas are all around the idea of reversion to the mean or seeing that same weakness in September hold true. So let's start with idea number 1, which is a return of that spring rally. This is that March to April period, which we saw became a little bit weaker this year. I'm looking for a reversion to the mean type of idea, where typically this is some of the strongest 2-month period that we see. I want to see that same level of strength come in. So trying to look for some sort of a long setup inside of SPY towards the tail end of February makes a lot of sense to me. 2, continued September weakness. In both 520 and last year, we saw this was the consistent pattern, so there's no reason why we should expect otherwise as we head into 2026. Either hedge with protective puts, either just trim some of your positions, or you could even take some of the inverse leveraged ETFs if that's something you're comfortable with. 3, the Santa Claus rally, which we did not see come true this year. Same idea as number 1, looking for a reversion to the mean here. Typically, we see that November period had that gap, and it might be November instead of December that actually gives us that level of strength. And so positioning towards the end of October might make a lot of sense, especially if there's a natural long setup that triggers. So if we were to summarize this, March through April, we have a bullish mindset. September, we have a bearish mindset. And November, December, more bullish mindset. Both of the bullish ones with the idea of a reversion to the mean, looking for price to go back to what it historically tends to do and fill in these gaps that we saw this year and instead go right back towards the averages that we have. Hope you found this video helpful. Again, if you'd like to run this on your own symbols or other indices, be sure to download the indicator. It's a completely free download. I'll leave a link in the description box below. Take care, everyone. Good luck trading and wishing you all a very happy new year ahead.